Welcome to This Explainer. Picture this. You wake up tomorrow, grab your morning coffee, check the news, and bam, the stock market just hit another all-time high. You check your portfolio and it looks absolutely amazing. But then you go to the grocery store and you kind of look around and wonder, why don't I actually feel any richer? Well, it's the ultimate modern financial mystery, and we're going to crack it today.
It is a pretty scary thought, but honestly, it's one of the most crucial concepts you can ever wrap your head around. What if those incredible, record-breaking gains aren't actually increasing your true wealth? To get this, let's look at a really concrete example. Imagine your stock portfolio goes up 10% in a single year. You'd feel great, right? But what if the cost of your rent, your groceries, and your vacations quietly goes up 15% in the background over that exact same time? You're making money on paper, sure, but you're actually losing wealth in reality. Your purchasing power is dropping. Today, we're going to uncover exactly why this happens, why the market can keep climbing while your real wealth stalls, and how understanding this dynamic can literally save you from making a massive investing mistake. Okay, here's our roadmap for today. We'll be looking at 1. The illusion of record highs, 2. The money supply effect, 3. History's warning, 4. Price versus value, and 5. Smart investing habits. Let's jump right in.
Section 1. The illusion of record highs.
So, you know how every few months the financial headlines absolutely scream about another all-time high in the market? When we see that, it is totally human nature to falsely assume that the underlying economy must be stronger than ever. But look at what actually drives these trends. It's not just corporate profits. I mean, yes, corporate earnings absolutely play a role, for sure. But prices are also heavily influenced by shifting borrowing costs, the massive hype cycle around new tech innovations, and critically, the sheer volume of money sloshing around the financial system at any given time. Sometimes the economy isn't actually stronger at all. It's just more caffeinated.
Think about it like this. Imagine two identical factories. On the left side, the first factory completely doubles its output. It became way more efficient, sold a ton more products, and its profitability genuinely grew. So the price of that business should go up. But on the right side, the second factory didn't change a single thing. It is producing the exact same amount of goods. But investors just got swept up in a frenzy and decided they were suddenly willing to pay twice as much for the exact same output. The business hasn't fundamentally improved one bit. The crowd has just decided to pay a massive premium. Recognizing which scenario you're looking at is quite literally the difference between investing and gambling.
Moving right along to Section 2, the money supply effect. To really grasp why that second factory gets so ridiculously expensive, I want you to think of the entire economy as a giant auction. Imagine you're sitting in an auction house bidding on this beautiful painting. If suddenly a huge group of new people burst through the doors and they all have these massive, overflowing wallets, what's going to happen to the price of that painting? The paddles go up and the price naturally skyrockets. The painting itself didn't magically get any better, there's just way more money chasing it. Well, the exact same principle applies to financial assets. And this isn't just a theory. When central banks inject trillions of dollars into the economy, like we've all seen happen in recent years, that money has to go somewhere. A massive chunk of it marches straight into the stock market. People arrive at the auction with bigger wallets, and it creates a mirage. Prices look like they are touching the sky, but often it's really just inflation wearing a tuxedo.
That brings us to Section 3. History has a warning.
I find this historical timeline absolutely fascinating because it shows how this cycle of wild market over-optimism just keeps repeating itself. Let's look back at the 1990s dot-com boom. Investors firmly believed that internet companies were basically invincible. We literally saw people valuing companies with zero revenue in the billions of dollars just because they slapped .com on the end of their name. It felt like this bold new paradigm, right up until reality violently caught up. The market corrected, and it corrected sharply. Fast forward to 2008. Completely different cause. This time it was real estate. But it taught the exact same lesson. Markets can stay irrational and incredibly optimistic for a shockingly long time. But gravity always eventually takes over. It's intoxicating though, isn't it? Bull markets, those long stretches where prices just keep climbing, they create so much confidence. But eventually, when your neighbor starts getting rich on some hot stock tip, that excessive confidence really kicks into overdrive. The fear of missing out takes over completely. People begin to genuinely believe that prices literally only move in one direction, up. Because of this, they start borrowing heavily to get in on the action. They invest money they truly cannot afford to lose. And worst of all, they completely stop preparing for uncertainty. History waves these massive red flags right at the absolute peak of the mountain, but the crowd is usually way too busy cheering to even notice. Now, no one knows exactly when a market correction will happen, but history repeatedly shows us that overconfidence is the ultimate warning sign.
Let's shift gears to Section 4, Price versus Value.
There's this famous rule in investing, popularized by Warren Buffett. Price is what you pay, value is what you get. Just because a stock's price tag gets higher does not necessarily mean the company actually became more valuable. Remember our auction from earlier? Sometimes the crowd is just willing to pay a higher price. Just because a price tag is high doesn't mean the diamond is real. Amateurs stare at stock tickers and completely obsess over daily price movements. Professionals, on the other hand, study the actual underlying business. Price simply tells you what people are paying at this exact fleeting second in time. Value tells you what a business might actually be worth based on its real-world performance, its assets, and its future cash flows. Those two numbers are not always the same, and when price completely detaches from the real-world value, your risk absolutely skyrockets.
Which brings us to our final part, Section 5, Smart Investing Habits. So, how do we actually survive this illusion? How do we safely navigate an environment where price and value completely detach? We do it by ignoring the noise and sticking to a ruthless playbook of habits. 1. Invest consistently, rain or shine. Use dollar-cost averaging so you aren't constantly trying to time the market. 2. Diversify across different assets so a single storm doesn't sink your entire ship. 3. Always maintain a cash emergency fund so you're never forced to sell your investments at a major loss during a downturn. And 4. Keep your emotions entirely out of it. You have to avoid those snap decisions driven by the fear of missing out on the way up or the sheer panic of a drop on the way down. Doing this successfully really requires a complete rewiring of your brain. The amateur mindset is basically like sitting at a slot machine. You're craving that overnight jackpot, completely addicted to the flashing lights and the thrill of a quick win. But true generational wealth, that's more like a deep-rooted tree. It takes decades to grow those deep roots. It's quiet, it's patient, and it weathers every single economic storm that rolls through. Smart investors are always focused on the long game. They focus way less on the noisy headlines screaming about all-time highs and a lot more on steadily and patiently managing their risk over the course of a lifetime. Look, no one has a crystal ball. The market might keep hitting new highs for years, or we might experience a massive correction tomorrow. But successful wealth preservation isn't about predicting the next crash. It's about making consistently smart decisions that actually survive one. So tomorrow morning, when the headlines inevitably scream about the very next all-time high, I want you to look at your portfolio and ask yourself one really provocative question. Are you buying a piece of a truly valuable business, or are you just buying a lottery ticket? Thanks so much for joining this explainer. Keep learning, stay patient, and we'll see you in the next one.